On today's episode of the Morris Financial Concepts podcast, we interview Bart Valley about everything 2024: AI, recession rumors, market highs, investment strategies. We've got it all in today's episode, so stay tuned. Bart, welcome back to the show.
Hey, thanks, Richie. It's great to be here as always.
So let's talk about market trends for 2024. What are the trends that have defined the year so far?
Yeah, I mean, overall, it's been a solid year for markets. Things have kind of coalesced around this central positive narrative that economic growth is slowing, but in a healthy way, and inflation continues to come down to healthier levels, and that the Fed will eventually start cutting rates this year. So markets have adopted this as kind of that central theme, and as long as economic data and reports have come out that support that narrative, the markets, for the most part, they have. Markets have continued to climb. There's been a few shorter periods where data has kind of come out contrary to that central narrative, where we've had some reactivity around those reports. But overall, again, a solid year so far. Stocks are well in front of what historical averages would be thus far year to date. And then bonds have provided some safety during those periods of reactivity. They've also continued to provide good yield and also some price appreciation. So overall, so far so good this year.
How have interest rates and inflation impacted investment strategies this year?
Yeah, so positively, albeit indirectly, through this same narrative. Interest rates, again, the Fed hasn't done anything with interest rates yet, but the thought is that they will begin lowering rates at their next meeting later this month in September. But really, inflation readings have been what's kind of been a positive impact on the market because inflation readings have been favorable. There's lots of different gauges for inflation, but CPI, which is a broad consumer price index measure, probably the most popular one in the media, certainly. In July, CPI slowed to its lowest year over year pace since 2021. And then the Fed's preferred inflation measure, which is something known as the personal consumption expenditure index, it held steady in June at 2.6%. So again, both getting down to healthier levels from where we've been over the last few years. So that's been a positive. And economic growth has been resilient but slowing, which is exactly what you want to see when you're trying to tame inflation.
So, how about the Federal Reserve? What should investors be watching for in the coming months?
Yeah, that's one of the things. What's the Fed going to do? So the Fed is watching this data, and again, recent data suggests that the economy is cooling off, that labor markets are slowing, which is something that the Fed wants to see, and then inflation is back down to healthier levels. So the Fed is taking notice, and they gave clear signal at their July meeting that they're um, prepared to cut the Fed funds rate by at least a quarter of a percentage point at their meeting in September, with additional cuts potentially to come this year. What does that mean for investors? It's a little bit harder to say. Just to go back for a second, the Fed funds rate is just the rate that the Federal Reserve targets for banks to use when they're lending to each other, just short-term overnight loans. So it doesn't affect us directly, but it certainly affects consumers and investors indirectly in lots of ways. So on the consumer side, again, it indirectly affects savings accounts, interest rates there, CD rates, credit card rates, a little more indirectly, mortgage rates. So lots of ways it affects us from a consumption standpoint. Um, and then as investors, bond yields tend to move in the same direction as the Fed funds rate. but the timing is not always clear. And so, again, generally rates move in the same direction. We can use the 10-year Treasury note as an example. Again, as Fed funds rates start to fall, 10-year Treasury rates should fall as well in the same direction, but the timing, who knows when that happens? And we can look at this past year as a good example. The Fed funds rate has not changed at all. It's been steady over the past year. But the yield on the 10-year Treasury had started the year at around 4% about 12 months ago. It went up over 5%. It went back down below 4% to 3.9%, back up to 4.5%, and now it's back below 4% again. So the bond market and the stock market, they're always, again, we've talked about this before, they're forward looking, and they're kind of weighing all those possibilities and probabilities. So it's not, there's not a definitive path with fixed income or stocks in the short run around Fed funds rate changes. So they're always kind of trying to price in those probabilities. So timing is a little more questionable there.
Have global events like political shifts and conflicts affected investment strategies this year?
Yeah, it's a good question, and the answer is, not a lot. We certainly always want to be aware of what's going on from a geopolitical standpoint, global risks, conflicts, changing political sentiments. And there are certainly times of reactivity when something big happens out there in the world. It feels like that's happening a lot. And we see some day-to-day reactivity around that. But again, the dominant theme so far this year has really remained that positive narrative of slowing growth, falling inflation, and pending rate cuts from the Fed. So the market has been pretty good at ignoring these individual pieces of bad news. We've talked a little bit in the past about how the human brain works around investing, but the human brain is wired sometimes to ignore or reject data that's at odds with prior or existing beliefs, and investors can be particularly good at that. And I think that's one of the things we've seen this year is, again, there's been one dominant theme that's really pushed markets forward, and investors have tended to push some of the negative news aside.
What role have emerging technologies like blockchain or AI played in shaping the investment landscape?
Yeah, that's been a big part of the story for the last couple of years, really, particularly those AI names. And chip maker NVIDIA has become probably the most recognizable name in this space, and one that most people hear about as far as kind of stellar investment returns over the past several years, and that's continued this year. NVIDIA is up another. The last time I checked, more than 120% just this year alone. One of the things we talk about with clients is, yes, we want to have exposure to NVIDIA and other market leaders, but we also want to have exposure to the hundreds, if not thousands, of other companies that are going to benefit from either innovation in the AI space or adoption in the AI space. And it's really going to affect countless numbers of companies out there. And the other thing is, with any kind of new and emerging technology, we can go back to the late 90s, or we can go back to the earlier days of cell phones and smartphones. It's really hard to know who the winners and the losers are going to be with an emerging technology before it happens. It's easier looking back, and we can say, oh, we all knew we should have bought Apple. It wasn't really like that in the late 90s. And so again, it's hard to know who the winners and losers are going to be. So we want to have exposure, broad exposure, and that's the beauty of diversification and why it's important here. But look, to go back to the question, everybody's talking about AI, right? So as a diversified investor, you can know when you go to that party and everybody's talking about NVIDIA and they've got some NVIDIA stock, you say, hey, I've got some of that too, because you do have exposure, but you've also got exposure to those hundreds of other companies as well.
How about the increasing debt levels in the U.S.? What should we be thinking about as far as those go?
Yeah, debt levels. That's been another thing that's kind of at the front of the news this year and really the last several years. and this is going to be something we need to continue to try to figure out as a country. We're at a little over $35 trillion is where the national debt sits right now. Um, you know, it's also important to contextualize this. And what I mean by that is, kind of putting that in a way that we can put it in relative terms so we can compare it to what our countries look like historically or what other countries look like with their debt levels. And one of the ways to do that is to take that total debt and look at it as a percentage of GDP or gross domestic product. Um, and if you look at that, we're at about 125% right now, debt to GDP ratio. And so um, other countries are higher. It's certainly high, and it's a level we don't want to be at forever, but other countries are higher. And we've been at that level historically. We've actually been a little bit above that back earlier, coming out of COVID when GDP fell and debt was high as a result of COVID. But if you think about it, and as an investor, what does this mean for me? We're at high debt levels. Can I do anything to take advantage of that? You might assume that if that debt to GDP number is kind of high in relative terms, that stocks are not going to be doing as well. That would have a negative impact on investments. And if it's low, stocks would do better. But if you look historically, looking back to 1975, we've kind of got good data going back that far. There's no real relationship between government debt and what stocks do. If you look at it year to year, the kind of scatter plot is pretty random. And, we can look more recently at 2022 and 2023 as good examples. Both those years, high debt to GDP ratios. 2022 was a terrible year for the stock market. 2023 was a great year for the stock market. So debt is not really a reliable or meaningful signal for investors. So going back though, it's something at 35 trillion. Is this concerning? As citizens, yes, but as investors, there's just no way to see this as evidence of what you should be doing from an investment standpoint.
How have cryptocurrencies and digital assets done this year? Is it time for investors to start thinking about those?
Yeah, and that's a pretty common question, and it's been a pretty good year for crypto and digital currencies. We can use Bitcoin as a proxy there, as a lot of people do. Bitcoin set record highs earlier this year. There's been a lot of volatility, a lot of ups and downs, but record highs earlier this year, and still I think up as of this recording more than 25% for the year. But again, from an investment standpoint, we still look at cryptocurrencies as more of a speculative play. And so what I mean there is you've got investing and you've got speculation. And really, we feel like crypto still falls in that speculation camp. And one distinction that we look at is for investments, there should be a way to kind of estimate a fair value for an investment, right? So whether you're talking about a bond where, hey, I know I'm going to get these certain interest payments at certain dates in the future, and then at this date I'm going to get my money back, or a stock where I'm getting dividends in the future, or I'm participating in expected growth of this company, or even real estate where I'm getting certain cash flow from a real estate investment. There's different methodologies for discounting those future flows and growth back to a current value and saying, hey, this is a reasonable assessment of what this investment is worth. With Bitcoin, what's it worth? I don't know. It's worth what somebody else is willing to pay me for it on that day. That's what it's worth. So given that there's no real way to kind of estimate that intrinsic worth, that's where it lands in the camp of speculation. So, hey, there's going to be a lot of people that make a lot of money in cryptocurrencies. There's going to be a lot of people that lose a lot of money in cryptocurrencies. But again, from an investment standpoint and as part of an investment plan, that's not really something we look at right now. We kind of leave that on the speculative side.
How are investors balancing long-term growth with short-term volatility? Is there a way to take advantage of that volatility?
Yeah, great question. And for investors, these two things, long-term growth and short-term volatility, they necessarily go hand in hand. That volatility is the price of admission for higher returns. Um, but when that volatility happens, it's scary, and it can be kind of sudden, and it can be kind of intense. Um, Being down here on the coast of South Carolina, we can use rip currents as an analogy, right? We go to the beach, and a lot of us enjoy swimming at the ocean. Sometimes there's rip current warnings, and how do we get ourselves in trouble if we get into a rip current?
Of fighting against it, right? I
Yeah,
think.
yeah. By panicking and fighting against it, and what we're really supposed to do is float with it, try to get to the side, right, and then calmly get back in when you can. And so, the same way we can look at investing, and investors, when they try to fight that volatility, that's a natural part of investing. That's when they can really get themselves into trouble. So
Mm.
there's not a good, reliable way to take advantage of volatility. It's more about just, again, designing a portfolio that's right for you, for your needs, and for your, kind of emotional wants around risk. And then being able to accept and embrace that volatility when it happens, because it will.
Is volatility different now? It sometimes feels like these ups and downs are more frequent than they were in the past.
Yeah, that's I think a question we get in a lot of regards is it different now? And that's a great question, and um, it certainly does feel like that with volatility a lot of the times. Is that, wow? It's a lot. There's a lot going on right now. But I think some of that tends to be from what we call recency bias. Again, another bias that we're prone to as humans, where we tend to put more emphasis on things that have happened more recently, and they feel
Hmm.
bigger and more important. But again, one of the ways to help fight those biases is to go back and look at data and see, what does the data tell us? And we can do that with volatility. And one of the ways we measure volatility, probably the most popular way, is something called the VIX index, or the CBOE volatility index. Not to get too technical, but basically think of that as a measure of fear, and a measure of volatility, sometimes called the fear index. And we can go back to 2003 and look at the average VIX number. And if you look at it going back to 2003, that average has been about 19, is that average level on the VIX. Certainly been some big spikes along the way, but that average number of 19. And if you look at the last 2 years, we've actually been significantly below that. So again, there's been some days where it's spiked higher, and some weeks certainly where numbers are a little bit higher. But overall, volatility the last couple of years has been lower than historical average. But it certainly doesn't feel like that, sometimes, right?
You have any thoughts on the upcoming presidential elections impact on the markets?
Yeah, it's certainly the big story this year. A lot of stuff going on related to the elections, and hey, it's people feel very passionate about what's coming up later this fall, and one of my jobs is to think about that, as you said. How does it impact our clients? How does it impact us from an investment standpoint? And nothing that's really impacting markets. And looking historically to, typically what we see in election years is we might have a little more volatility in the months right around the election. But if you look a little more broadly, there's really been no meaningful difference in historical returns in election years versus non-election years, and there's
Mm.
really been no meaningful difference in who's been elected, meaning Democrat or Republican. So again, it's not something we plan for from an investment standpoint, and typically not something that's mattered all that much, because there's so many other things that affect the investment markets. But what we do always want to have our eyes open to and our ears open to is potential legislative changes that might affect our clients from a wider planning standpoint. So potential changes in tax rates, potential changes in the state tax laws, potential adjustments to retirement plan policies and guidelines. Those are the types of things that we're always looking at. Again, it's hard to predict what's going to happen, and those are legislative changes that take not only the president but also Congress. So a lot of questions still out there as far as that goes, but something we're always looking at and thinking about. What are the potential changes that we might need to be considering that will impact our clients?
The ongoing chatter of the recession potential, how are investors reacting to or mitigating these risks?
Yeah, and that's something, again, chatter about recessions has been out there for a couple of years now, and that's another example of something that's really hard to predict. And it's something we only know in hindsight. But trying to predict, will we end up dipping into a recession? If so, when will that be? How will markets react to that? And when would markets react to that? All very hard from a prediction standpoint. Um, but as far as mitigating risk, one thing, again, one way we look at it is sometimes it's going to create some shorter term volatility, and investors need to be prepared for and accepting of that. And one of the ways I kind of think about it and what we've seen this year is, I mentioned earlier that we've kind of had this prevailing positive narrative with markets so far this year, and investors have tended to push aside data that doesn't fit that narrative, meaning negative data. But the way I look at it, if you think about, if you ever been to a kid's water park where they have those giant buckets, up above you to fill up with water, and eventually they fill up and dump out, and they can dump out kind of violently, right? That's the way I look at it with markets and negative news this year, is that, whether it's talk about a recession or other kind of negative economic data that doesn't fit that narrative, gets set aside, but it's kind of gradually filling up this bucket, right? And then when it gets too full, it dumps out on us kind of violently. And we saw an example of that in early August. Most investors will remember we had a pretty significant downturn in early August, and it was a scary few days for a lot of investors. But that was one of those times where things had kind of built up, and then some more negative economic news came out. And it was almost more of an emotional reaction than a fundamental reaction, because overall the story was still pretty solid, but it just got to that point where the bucket tipped, and there was real emotional reaction, and kind of everybody ran for the doors for a day or two, and then things started back on their positive track. So again, being prepared for that volatility that will happen at times. And the other flip side of it is when things are going relatively well for a couple of years, as they have been now, reminding investors that they won't always go well. And so talking to our clients about not getting too greedy, because again, we can be driven by emotion when investing. And sometimes if we let emotion guide us, those greedy, euphoric feelings come when markets have been doing really well for a while, and those feelings of panic come when markets have been doing really poorly, and those tend to be, tops and bottoms. And so if we let emotions drive our investment decisions, we're buying and selling at exactly the wrong times. So again, it's working with clients to work through those things, and avoiding greed when markets have been doing well, and kind of sticking to that longer term plan.
How about market valuations? With the market having such highs, should investors start reacting or acting more cautiously?
Yeah, that's a question we often get from clients, is with markets at highs, as they've reached several new highs this year. Should I do X, Y, or Z, or should I not do X, Y, or Z? But there's really no compelling historical evidence to support any value add from trying to time markets around market highs. If you think about it, market highs are not uncommon. Actually, if you look historically, a new market high happens on average about once every 6 weeks. So it's normal, and there's no need to act or to not act around market highs. I think that goes to the wider point too of, whether we're talking about market highs or we're talking about possibilities of recessions or we're talking about upcoming elections, we are bombarded with information 24 hours a day. And it naturally feels like sometimes, what do I need to do? Something, right? Um, and as advisors, we want to help our clients through that. So we want to sit down and develop and define a unique plan for each of our clients. And then we want to be both guides and companions on that journey. And so certainly there can be reasons to change portfolios, or change your investment strategy. Life changes, right? There's changes in your needs, rebalancing, to kind of keep the portfolio in line with longer term plans. Or sometimes emotional reasons can be valid reasons. If you're feeling like, hey, this is all too much, I'm just too worried, you can just sit down with your advisor and talk through what that might look like to make portfolio changes. So there are reasons to change, but reacting to what's on the news is never a good reason for that. So again, if you've got questions or changes or needs that are different, you can sit down and talk to your advisor about that. Otherwise, we encourage clients to feel free to tune out that kind of noise that's out there 24 hours a day and continue on with their well-established longer-term plans.
Bart, thanks so much for being on the show. It's great to get some of this and put 2024 in perspective as where we really are right now, because I know there's a lot of emotions happening. Thanks again, and look forward to having you back on the show.
Absolutely. Thank you, Richie.